Welcome to my video. I want to explain to you, bring you up to date, what's going to happen with the market. There's a lot of misconceptions going on. But first, before I do that, I just want to explain something to you. This was our first tech in our crash right here, a run-up, then our crash, housing run-up and crash. So that was our first bubble, our second bubble, and then our third bubble. This was ready to start coming in 2012. This was ready to start breaking right here and start coming down just like the other ones. So that'd be then our tech bubble, housing, financial bubble, and this would have been our third, our QE bubble. But something happened. They got so excited in 2012 with stock buybacks. The Fed kept printing and printing money and giving it to companies so they could buy their own shares back. When you buy your own shares back, that means that you have less shares and you spread your earnings around on less shares and the stock price goes up. So that's how they camouflage a bad quarter. They can make their stock price go up, make it look better, okay, by buying more shares, getting shares off the market. And that means with fewer shares, they spread around their earnings on fewer shares. Earnings go up, stock goes up. It's all fake. It's all an accounting trick. Now, by 2012, the reason why they didn't let it drop here, it dropped here automatically and dropped here, and it should have dropped right here, but they came in, the plunger team, or let's say Aunt B, came in and propped it up. So they came in and propped this baby up. They wanted to prop this up like that. With more stock buybacks. But here's the problem. The stock buybacks now, they got a problem on their balance sheet. We've been doing this so long, companies, that if a company had, for example, let's say he owed $1 million. They borrowed $1 million at 0% money, okay, and their stock was $10. Well, the $10 supports the $1 million, okay? Now, when they print and print and print and give them more money, they buy more of the shares. Okay, now they borrow another, now they owe $3 million. They borrowed $3 million from the Fed, printing money. Now the $10 doesn't support, okay, their debt anymore. They better get this guy up. And they do. And they bring, that's why they buy it. And they bring it up to, let's say, $15. Now the debt, let's bring it all the way up here. And let's say now they bought 5 million shares. And the stock now to support 5 million has to be at $30. Here lies the problem. So earnings are not growing, revenues are not growing, profits are not growing. Stocks are going up 6 times faster, okay, than earnings or revenues or profits. So it's all fake. It's called a bubble. They got into a habit with such easy money to be made, like cocaine addicts. They just couldn't stop. They were hooked. So now here's the problem. What they call balance sheet deterioration. Because the stock is only worth really $10. It's not worth $30. That's called a bubble. So if it gradually moves back, that's okay. But it's got to move back, okay, gradually. But it doesn't happen that way in the stock business. We have volatility, okay? And all of a sudden what's going to happen is they're worried that the $5 million they have in debt can be supported by $30 a share, which everything looks good on their balance sheet. Everybody's happy. But then all of a sudden, if they're not buying any more shares, and let's say the share price drops to 25, they're in big trouble. That means their balance sheet is getting ripped apart, okay? So at $25, they can't support debt of $5 million. It's got to be at 30. So as it comes back to 25 and so forth, the balance sheet then gets worse and worse looking. And that's when they go into default. And we haven't had so many defaults. We got more defaults than we've ever had, corporate defaults, because of that. So what are they doing? Every day when you get more bad information, financial information, like pending home sales we had, just got decline. Price for used cars are plunging. Inventory in used cars are rising. Wheels are coming off the new car sales. Okay, terrible. Retail sales are falling off the cliff. It's a matter of fact, it's so bad, it's in recession territory. Business inventories and sales are tumbling. Wholesale investment drops for 6 straight months. Factory orders have fallen, okay, to the lowest level in 2009. It just goes on and on and on. So they disconnect themselves. They don't care about the fundamentals. The stock will keep going up as long as the Fed is there to print money. Okay, keep printing and give the money to the company. They can buy their own shares back to prop the share up, and then they support what they owe. But it's a Ponzi scheme. It will stop. And when it stops, you want to be prepared, just like here when the bubble crashed, and like here. And we'll be ready. We'll be ready because we're going to be using to track it our PT2 chart. And that will tell us on the S&P. We're going to watch the banks, and we're going to watch especially the banks, because the banks are the ones that go first. If the market's going to collapse, it's the banks that starts showing you. And let me put it up here, symbol XLF. Okay, and when the banks, like here, see when we had the market start to collapse here, we went down 14%. See how the banks started to turn from green to red? See, we went up, they had a couple little green day there, but then it didn't last long, then she dropped. So we just short it, okay? We're going to do the same thing here, it just turned green, but when it turns red and this crosses over the yellow, remember, it's always got to be, so we're going to monitor the bank stocks, and when this crosses and these are red going down like this, we'll short. And same with the S&P. This is great for people who have no time. SPY right here. So again, see, when this starts turning red, see right here, when this turned red, we sold short, we made some good money. Turned green, we went long again. Now we're long again. When it turns red, we'll short it again. But this will collapse, don't forget. There's no difference between these bubbles right here, and this is the extension, and this is incredible, okay? This will collapse too, just like this and like this collapses, okay? They all have the same thing going on. As soon as there's no more demand, then you have what we call pricing, okay? Then pricing starts dropping. And when you get price weakness and it starts dropping, it's over. The balance sheets get killed. And now people take their money out and the market drops. So join the gang. I hope this helped you. Why don't you join the gang? Learn how to use the PT2 chart. It's the greatest tool, especially for people that don't have hardly any time. So easy. Turns green, you buy. Turns red, you sell short. Okay, check it out. Go to my site, philsgang.com. Become a member. Try it. See you on the charts.